Have you ever wished there was an easy way to invest in the stock market? Well, of course you have, and your Uncle Paul is here to help. Not only is there an easy way to invest in the stock market, but I'm also going to show you how to beat the returns of 99% of financial planners over the course of your saving history. The strategy I'm going to share with you today is going to give you the ability to retire with millions of dollars. So do me a favor and smash that like button real quick for me on this video. So the strategy is very simple. It's called an index fund. And I'm sure you've heard about this because great investors like Warren Buffett, Seth Klarman, Howard Marks, they sit there and talk about investing in index funds, low cost index funds. So the question is, what is an index fund? Very simply, we have the Dow Jones, we have the NASDAQ, we have the S&P. These are three indexes that people invest in. An index fund does it very simple. It invests in all the companies in that specific index. Very simple. So why would you invest in an index fund? Well, very simple. We like teaching this channel how to pick individual stocks, and we think that's really important once you're ready. But 15, 16 years ago, I was 100% index funds. I bought SPY, which is an ETF, which I'll get into very shortly, and it bought the entire S&P 500. As time went on, I started to get into more individual stocks, and I would sell some of my index fund and buy individual stocks. Now, my goal is to only own individual stocks, but you're probably not there yet, and that's completely fine. You need to dip your toe in. So in the meantime, investing in something like SPY or VOO is a great way to beat most financial planners. Now, how does that happen? Well, for those financial planners out there, what they're going to do is they're going to sell you mutual funds. Okay, great. But mutual funds have very, very high fees. They're actively managed mutual funds, which means they have research teams, they have this. But the big thing they also have is career risk. What's career risk? Well, they got to try to beat the market or get very close to it. So if they see a stock flying high and they don't want to own it, they still have to own it. Why? Because how do they explain to their investors that they're trailing the market in a certain way because of overpriced companies? They're going to sit there and they're going to buy those crazy investments. Okay, so what's going to happen when there are big drawdowns in the stock market? They're going to go along with it. The index fund is going to match the market basically dollar for dollar. There are very small fees. We're talking about mutual funds. Mutual funds tend to charge between 0.5 and 1% per year. While an index fund, something like SPY or VOO, which is like an exchange traded fund, their fees are 0.003 to 0.009. 0.09. Sorry. What this means is for every $1,000 you have in a mutual fund, you're going to be charged $5 to $10 per year. Not bad, right? However, for this ETF here, you're going to be charged for every $1,000, you're going to be charged 30 cents to 90 cents per year. Now you might sit there and say, well, it's still not a big deal. Well, let me pull this up real quick and show you how much this matters. In our software, we have a great tool called a retirement calculator. Let's say you're 30 years old. And again, I'm making assumptions here about our viewers being between the age of 25 and 45. And this is the data that YouTube gives us. If you're younger than that, awesome. If you're older than that, also awesome. There's great information here. So don't take my assumptions here as anything to write home about. It's just to show an example. And let's say you're 35, you're gonna retire at 65, and you currently have 100,000 saved, and you're saving 10,000 per year. And let's say you increase your savings by 3% per year, and you get about a 9% return while you're saving. And during retirement, you get 6.5% because you're probably going to be a little more conservative, and you expect to live to age 100. And let's say inflation ends up being about 3.5% per year, and you currently make $75,000 a year. All right. The final question is, what percent of your income do you want in retirement? The reason I ask this is most retirement calculators don't factor in living from retirement until death. So I always like to be conservative and say I'm gonna retire on 100% of my income from today. But remember, that income is going up 3.5% per year, so it's going to factor in that increase in cost. You generate your returns. You basically are very close. You just need to save $9 more per year. So you're basically there. That's assuming you buy a long-term index fund with very low fees, 9%. Okay? Now, let's say you buy that actively managed mutual fund from your financial planner. Well, here's the issue, guys. Not only are they charging you 0.5 to 1% per year, your financial planner is also charging you the same fee. And History has shown on any given year, only 82% of actively managed mutual funds beat the market. And over a 10-year period, it's in the low single-digit percentage. So let's say your mutual fund also trails the market by 0.5% per year. So you're paying 0.5% a year to the mutual fund company, you're paying 0.5% a year to your financial planner, and you're losing out on 0.5% per year minimum on performance. That's a total of 1.5% per year in reduced returns based on the market. So if you remember, I assumed 9% returns, but now we're at 7.5% because of the fact that we've lost those 3 areas of returns. Now, how much does it change our retirement? Guys, instead of having to save $9 per year extra, you have to save $7,400 per year extra to retire. You almost have to double, you have to increase your savings by 74%. Guys, I don't care how you cut it. And I have friends who are financial planners, and their job is more than just picking the right investments. It's all about giving you a plan. However, is this cost worth it to you? That's how I have to ask you. Is this worth it to you? To go in total dollars at 9% return, at the age of 65, you would have 5.5 million. At 7.5% return, at the age of 65, you would have 3.7 million. That's a loss of $1.8 million. 1/3 of your retirement gone. All because you didn't invest in that low-cost ETF. Now, guys, my personal perspective is I'm going to own individual stocks. I feel comfortable with that. My fiance, who has her own money, I put her in low-cost index funds. Because to me, I just wanted to ride out, and I don't want her to worry about, is she beating, is she not beating the market? I can just tell her every year, you match the market. And that's all that should matter for her. She has a rental for herself. She has other investments she makes every year, but every single dollar in the market we put in the low-cost ETFs. Someday when I die, my estate will absolutely say, put my money in low-cost ETFs. I want to take the thinking out of my estate. I don't want anybody who's inheriting my money to worry anything about trying to beat the market or trying to do anything. Low-cost ETFs. And that matches what a guy like Warren Buffett does as well. His estate says, once I pass away and you guys get money from me, put it in low-cost ETFs. So I mentioned SPY and VOO, and these are the two that I put my fiance in and what I recommend everybody do. Now, the great thing about index funds and ETFs is you can find these things to find any sector, any sort of index you want. The Russell 3000, the Wilshire Index, whatever you want, you can find there. But for matching the S&P, SPY and VOO, I think are just great choices. That one's by Vanguard, which is VOO, and one's by Spider, which is SPY. A great opportunity. SPY's fees are 0.09% per year, and VOO is even cheaper at 0.03% per year. That is so cheap to buy the entire S&P 500. You're getting the 500 biggest companies in the US. All of you guys probably have a brokerage account. The great thing about SPY and VOO is they are exchange-traded funds, which means they're funds that trade like a stock. So any brokerage account can go out them and buy them. Okay, you can go out there, type in SPY, how much you want to buy, boom, it does it for you. Now, the next step is, well, how do I become that millionaire from doing this? Well, it's about saving every single month, every single year, every single quarter, whatever it is you choose. I'm on Twitter, and I see people saying, hey, I got my paycheck this week, I'm putting X amount of dollars in VOO or SPY or whatever stock they want. Whatever it is you do, the key is to stick with it. It's called dollar cost averaging. And if you've watched our videos before, I always show this chart. The stock market's value, to keep it simple, is going to go like this over time. However, the price will go like this over time. And a lot of people who are morons would say, oh, I'm going to sell here, I'm going to buy here. Guess what, guys? Impossible. That's why we believe in dollar cost averaging. If you want to get this average purchase price, you got to buy all the way along right here in equal increments. Sometimes you're going to overpay, sometimes you're going to underpay, but over long periods of time, you're going to pay this. And the best part is you don't have to think about it. You have to just do it every single month, every single quarter, every single year, whichever method works the best for you. If you do this, you're going to decrease your stress, you're going to decrease your thinking, and you're going to match the market over long periods of time. Over 20-year periods, the chance of making money in the market is essentially 100% almost. It's like 99 point some percent. Over short periods of time, it's about 50-50. The chance of making money any given month, any given week, any given day, about 50-50. But over long periods of time, over decades, it's virtually guaranteed. And along the way, the entire S&P is going to pay you a dividend. So as you build your money up, it's going to give you a check every single quarter, every single month, whatever it is, to let you go buy more. So as you're sitting there, you're going to get extra cash that you also put in to sit there and keep reinvesting. You work too hard to sit there and have your money go away to fees for mutual funds that are going to underperform, the actual underperformance, and then pay the financial planner. The reason we created our community was specifically for letting people vent out and talk about things as they get scared. Are financial planners useful? I'm sure they are to many, just like insurance is useful. But at the same point, you don't have all your money in insurance. You can do a lot of this yourself. It's just about having the discipline to buy month in, month out, and not think about it at all. If you do that, you are sure to succeed and make a lot of money in the long run. Because at the end of the day, there are so many studies that show that people, individuals, retail investors, which is what the individual is, buy at the wrong time and sell at the wrong time. And even though the market does 9 to 10% a year in returns, the average investor gets half of that. That is a huge loss to investors. So don't think about it. Just buy month in, month out, SPY, VOO, or whatever comparable index fund that you can find and match the market. Take the thinking out of it. Take the stress out of it. Focus on increasing your income and focus on your family. That way, when you retire, your money is just sitting there. And on top of that, you don't have to worry about paying taxes along the way. You can sit there and keep it in one fund, not sell, buy. Their job is to buy and sell companies as they enter and leave the index. You don't have to think about it at all. So what kind of world do you want to live in? Do you want to live in a world of stress and worrying about where the market is? Or just know that every single month, if the market's high, you're buying in. If the market's low, you're buying in. But over long periods of time, this is the return you're getting. My goal on this channel is to give you a process that you can sit there and replicate very easily. Investing is simple, it's not easy. The hard part is the emotion. So take a lot of the emotion out, find your long-term ETF and buy it. And if you want to learn how to pick individual stocks, keep following us. Keep learning, and over time, you can start to dabble into that. But just like I was years ago, don't get into it until you have the right process that you feel comfortable with. Stick to the ETFs, and I guarantee you will be very happy you did 30 or 40 years from now. Thank you for your time.